Hi guys, I'm going to chat to you about how much cash you need to do your own property development project, whether that's a residential house or you're building townhouses or multiple houses. My name's Adam Panisi. I do these videos, they're completely free, and hopefully they help you to do your own property development projects. One question I get asked a number of times, and it was a question that I always had when I first started in property development, was how much cash do I actually need to do my own deal? So it doesn't necessarily have to be your cash. You can go and get joint venture partners or investor partners, or you can vendor finance it, as in vendor finance the capital. But the main question I used to have, and what other people have asked me, is how much cash do I need because I'm sitting on this block of land and I want to develop it, but can I afford to develop it? Or if I do need to go and raise money or get the money from someone else, how much do I actually need to get? So I'll put it into two categories. One is a residential lending scenario, and the other one will be a commercial lending scenario. So it doesn't matter whether the property itself is residential or commercial, take that out of the equation. Let's just assume we're doing a single residential house or even two residential houses. If you have the serviceability to meet repayments on the loan amount for a single house or two houses, even up to four in some cases, so 4 houses or 4 dwellings, if you've got the serviceability, then you can qualify for bank lending. So bank lending will be the cheapest rates, it'll be the lowest cost, but the loan to value ratio will generally be like a residential type rate. So just check this with your broker or your banker. But my previous experience has been, if you do qualify for a residential loan product, the maximum LVR you can go to is 80% LVR with most banks. So that's 80% loan to value ratio based on the end value of the project at the end. So that's what a valuer has put on it. So if you bought a block of land for $1 million, you're building $1 million house or $1 million for 2 houses, well then you can get up to 80% from the bank, and then the other 20% you need to come up with. So in that scenario, you need to come up with $400,000 in capital. Now, if you don't have $400,000 in capital, well then you need to go and get that from somewhere else. So that can either be by way of vendor finance, you can get it through, say, another unsecured loan. It might be a bit difficult for that large amount. Or you can borrow it from friends or family, or you can joint venture with somebody who chips in the cash. So there's a number of different ways you can get the $400,000 if you don't have it, but you can do it that way. So just take into account for that scenario, so $1 million for the land, you're building a single or 1 or 2 houses, maybe even up to 3 or 4 in some instances. The bank will lend you 80%, so you've got to come up with the other 20%, which is $400,000 of the end value, which in this case we've assumed to be $2 million. So that's that scenario. If we take the exact same situation, except now we're building, say, 5 dwellings, so as soon as you're over 4 or more, generally you go into what's called commercial finance. Now you just need to check this again because this changes all of the time. I believe at the moment 4 or less you can get treated as residential. So assuming you're building, let's just pick 4 for simplicity's sake. So let's just say you're building 4 residences or 4 dwellings on this property. So you're buying it for $1 million, you got $1 million in expenses, so again you're $2 million. Most banks traditionally, as soon as you're into commercial, you'll be at 65% LVR. So now you've got to come up with an extra 15% versus the previous scenario. So now on the $2 million end value, you've now got to come up with $700,000. So you've got to come up with 35% deposit or 35% capital equity. So again, same thing, if you don't have the $700,000, you need to borrow it from someone, you need to vendor finance it, whatever it is, you need to do something creative to get it. But if you're doing the deal, just be aware that if you are into that commercial space and you do want to get bank funding, then your LVR is going to be 65%. Now, one thing I didn't mention is you don't need to have the serviceability in this situation. So the bank won't necessarily look at your serviceability. They'll likely capitalize the interest. So that's another thing. You've got to consider that the capitalized interest also forms part of that 65%. So your effective LVR may only be like 61, 62. So if you can service the debt, you can service the interest every month, then you can borrow the full 65%, the 700. So you need to chip in 700,000. If you can't and the interest is capitalized, well, then that gets reduced from that. So say in the instance, I know when I first started, I couldn't service the debt. We pushed the LVR to 65%. The interest got capitalized, and then you've got fees on top of that. So bank fees, they're normally pretty low. They might only be 1%. So you've got to take all of that into account. So your total effective LVR may only be 61 or 62%. So you might need to chip in, say, another 5%. So there's another, on a $2 million end product, there's another 5% you've got to put in. So you're now up to needing $800,000 cash on a $2 million end value. So it sounds like a lot of cash, and I know when I first started, I was pretty overwhelmed by some of the numbers, as in some of the numbers meaning the cash I needed to put into these deals. Now don't get me wrong, you can do property development, you can start with no money, and you can do major deals. I literally did that. I started with no money. I did a $3 million deal with my first deal. Now, with that deal, I staged it into 2 stages, so it reduced the amount of capital I needed to come up with. So for example, if you're building, say, 4 houses, why don't you look at building 1 or 2 first, getting a residential loan on those, and then building another 1 or 2. It just reduces the amount of capital you need, and it also means that you can complete some product, you can sell it, get that cash in the door, and then do the other couple. Now, if you want to do it in one stage, that's great as well. You've just got to take into account that you're going to need that capital, and you need to get it from somewhere. If it's not out of your pocket, you're going to need to get it from somewhere else. So in my program, I tell you about how to go and raise the capital, or how to do creative finance where you don't need to necessarily put up the capital yourself. There's ways to do that. There's 101 different ways to do it. You want to do it properly, professionally, and you also don't want to break any rules either. And by breaking rules, I'll cover that off in another topic. That's a whole nother conversation, but there are rules and laws around capital raising and how you can do it legitimately. And I have gone down this path and have seen a lot of people doing it incorrectly. So if you get it wrong, there's pretty big consequences. So I hope that's helped and gives you an idea on how much cash you need to do your own project if you're looking at that, or if you need to go and get the cash from somewhere else, how much additional cash you need. Now, one last thing I want to add is I've just discussed about bank funding. Now, a lot of developers, especially in the current market, don't do traditional bank funding. So there's what's called private funding, second tier funding. You've probably heard it all before. So their LVRs on those instances, those lenders, they're private, they're non-banks, they'll push the LVRs up higher. So some of those banks might go to 70, 75% LVR, and that's LVR of end value. So that may mean that instead of having to chip in $800,000 of cash, you might be able to get away with quite a bit less. And just one other consideration as well, which I didn't put in there for commercial lending. I don't want to overcomplicate it in this video, but you need to keep in mind that that's the end value, and there's also the profit margin built into that if you're doing a property development. So in the original instance or scenario, I said $800,000 capital you need to put in. One thing I didn't take into account, which I just thought of, sorry about that, is you generally need 20% margin. So on a $2 million deal, you're probably going to have $300,000 profit in there. So that $800,000, you probably only need to chip in $500,000 in your own cold hard cash. If you've got a bank that's going to push non-traditional lender That's going to push the gearing, the LVR. They might go to 75% LVR rather than 65. So there's another 10% in lending. So your 500,000 might all of a sudden become 300,000. So you can see how easy it is to go from, say, 800,000 with a deal that's got no profit to then, so 800,000 on an end value of 2 million. I hope I haven't confused you. If I have, maybe that's another video or I can explain the ins and outs. But 2 million end value, 65% LVR with a traditional bank, you're chipping in 800,000, that's assuming capitalized interest. Scenario 2 is you've got 20% margin built into that 2 million end value, so then that reduces it to about 500,000 capital needed. Then if you've got a bank that's going to push the gearing to say 75%, then you only need 300,000 in your own capital. Now, you'll probably agree with me, it's a lot easier to get 300,000 cash to do a $2 million deal than what it is to try and get $800,000 cash. So in either case, you still need to come up with the money from somewhere, either creative finance or your own pocket. And you've got to take into account also with the banks and non-banks. The non-banks are going to have much higher interest rates, they're going to have much higher fees. So you've got to take that into account with your feasibility. Now, personally, from experience, the first deal that I did and the first few deals as I was building up, I did it with traditional bank funding, low gearing. I staged the developments and had low rates and all that stuff. I've since moved up to much larger projects. The bank's appetite for development funding has changed a lot in the last 11 years. It's gone through different cycles where they love financing, then they hate it, and then they love it again. So at the moment, most of my loan facilities are not with the bank, and that's on a couple of different reasons. One mostly is the gearing. A lot of banks with the development finance that I'm doing will go to 60-65%. Not only that, they'll take 3 to 6 months to turn an application around, especially considering the group or the company structure that I'm involved with or that I have ownership of is quite complicated. So where I currently sit is most of my loans are non-traditional or second tier, so you do pay a premium for that. As I'm transitioning through to completed product and I'm retaining stock, those construction facilities and those development loans that are more highly geared at like 70% LVR, or even some of them even a little bit more, then they'll revert back to traditional bank funding where the rate will drop to 2.5% and the fees are quite lean. So you've just got to take into account your own circumstances and what's right for you, whether or not you want to chip in or you've got the ability to get more capital, or whether it's worth paying a higher rate and being able to get a higher LVR. So it all comes back to being able to complete the project. If you're going to pay an extra 5% in interest and it means you can complete the project, well then it's worth doing. Whereas if you're going to save, say, 5% a year in interest, but you got to come up with an extra $500,000 and you don't have that cash, well then you need to weigh up, is it worth sitting around on whatever your development side is and not being able to complete it, or is it worth locking in the profit? Maybe it'll cost you an extra $100,000 to complete it, but it's worth locking in the profit, finishing the deal, and then maybe once the deal's finished, then you might look at reverting it back to traditional bank lending once you've got that income from whatever product you've built. So I hope that's helped. If you've gotten value out of this, let me know. Hopefully I haven't confused you too much. Finance is a little bit complicated when I'm talking about the overall broad. I might do some examples on some of my projects and how much cash I've needed to put in, and maybe put some numbers around those figures so you can see it in the flesh. Thanks for watching. If you like it, just give us a thumbs up and let me know what else you want me to talk about. Ask a couple of questions. Would love to hear from people what they want to know. Thanks for watching. Have a great day.